Welcome to the What to Watch video update. This is the final video that I do over the weekend where I put together everything that I've been analyzing and put it into this particular video. And I break it down into three categories. Those things that are positive, and yes, there can be some negative things that we see. Those things that are negative, and yes, there are some positive things we can see. And those things that we're just keeping an eye on for the time being to see if they're shifting one way or the other and will ultimately have an impact on the S&P 500. And this week we're asking the question, will seasonal weakness develop for the S&P 500? Now, the reason for asking this question is I've been watching this since the middle of July. I even did a couple of videos that I posted. It hasn't developed yet. But I would rather be watching for something that doesn't happen than have something happen that I wasn't watching for. I like to have as much information as possible, and I like to share that in these videos just to see what I'm observing. Now, August has yet to be positive in a post-election year going back to 1950. It has a perfect track record of being negative. We're halfway through August right now, and we were setting recent all-time highs with the S&P, the NASDAQ, and NASDAQ 100. The Dow set an intraday all-time high on Friday, but then gave up a lot of those gains. Earlier in the week, this past week, it was quite positive. CPI came out, and the market really liked that. Everything looked like it was getting set to possibly go higher, and then we came out with the PPI report, which was much stronger than expected. And are those increases that we're seeing there going to be passed on from the PPI to the CPI, which shows inflation's going back up? And that's one of the things that the market is dealing with right now. There was even talk earlier in the week of, well, how about a 0.5% cut at the next Fed meeting in September? That's kind of been pushed aside right now. And it's like, okay, well, we'll be happy with a 25 basis point cut or 0.25%. Well, if these economic reports that come out between now and the time the Fed meets in the middle of September, if they show inflation getting stronger, the Fed may not have to, or they may not be able to cut rates at all. And so there's still some time between now and then. We have about a month, and a lot of things can happen. There's also a lot of geopolitical things going on with the summit between Trump and Putin. And then, of course, things in the Middle East and between Russia, Ukraine, and then anything else that could creep into the picture at any time. And this is being prepared for Monday, August 18th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right, so let's go through the positive areas first. Now, a week ago, I was looking at this and treating it more negative. I tend to go with whatever direction the line's going in at any given time until we get to an extreme reading, around the 75 level to the upside and around the 25 level to the downside. Well, we were coming down a little bit here, but now we've been going back up, and it's looking more positive. So for right now, sentiment is improving. Now, this is positive overall, but we're seeing a few cracks here. This is high beta to low beta, and then taking a ratio. High beta stocks are those that tend to outperform when we're going up, like Microsoft, Nvidia, Google. And that's great, and that really pushes this ratio up when compared to low beta stocks. These are more defensive stocks that people get into when they're afraid the market's going to go down. And sometimes these stocks even go up when the market's going down. But you can see how we're chopping around right now. We're not seeing an awful lot of conviction. Now, it's still positive because as we were coming up out of the lows in April, we're still looking pretty solid overall. But it's starting to slow down here. So we want to keep an eye on this. If this ratio starts to fall, that could be more negative. If it turns and goes back up, that will be more positive. A similar thing here. This is value to tech, kind of a reverse of how we usually look at this. This is just looking at this ratio. When it's going down, that's more positive, and it's still going down, and that's positive for the market. But you can see how lately we just kind of blipped up here as value is starting to turn up, but not enough to change anything at this point. So this is still in the bigger picture positive for stocks, but if this continues to go up, that's going to be more negative. And then looking at the intraday chart, because we had an up week, it wasn't as solid of an up week as what we saw the week before, but we still ended positive here, where we saw a lot of the strength come in. There was a lot of gyration right after the open on Tuesday, but CPI was reported an hour before the market opened, and that ended up driving prices higher. This dashed line, that was the previous all-time high. Then on one hand, this is positive when we gapped higher on Wednesday, but then we set the high right after the open and then closed off of the high and spent a lot of the time coming down. Now, we did see a little bit of strength going into the close. This was a pivot point right down here where the market found support. Then on Thursday, we actually gapped lower, but you still had to buy the dippers. They don't really seem to care what's actually going on economically or at the macro level. If they see any weakness, they come running in and start buying. And that was enough to push this back up. Then we came down, then we went back up, then we came down, then we went back up. Very choppy day on Thursday. And then we actually had a stronger open. We set the high right at the open on Friday and then closed down well below that and down below this solid blue line here, which is the daily pivot. So not real positive price action, but not terribly negative either. But you can see some cracks here. We set the high and then closed lower. We set the high, closed down. We set the high, we closed down from there. That's not a really strong market at this point, but we are still going up on a closing basis, and that is positive. And here is the daily chart. We're looking pretty good here. Still higher highs, higher lows. We're back to dealing with this dashed line, which is a pivot point, which we got a little bit above it and then a little bit below it, but we're kind of right on it now. And that could be acting as support or resistance at this point. But in the bigger picture, we're still positive. We're in an uptrend. But most of the days, we were a little bit above average. I initially thought this was below average, but Friday was options expiration, and we tend to see a pickup in volume on that day. But you can see all the trading days are below this moving average. And we're still below 20 with the VIX, even though we ticked up a bit on a closing basis with the line chart. But we're still below the moving average. We're also below the moving average with the bar chart. So this is taken as less fear in the market. And we're still looking good with our short-term trend, measured by 20 periods. The green line, the blue line are going up, and prices above both. That's positive. And the intermediate term trend, we're not above the red line yet, but we're back above the blue line, and both the lines are going up. That is positive. And then we look at some short and then a little bit intermediate term trends here. We're above all the lines. This is called the bow tie, and it's a 10-period simple moving average. That's the green, and that's now going back up after it had been flat. And then a 20 and 30 period exponential moving average. And all these lines are going up in prices above all the lines. So that is positive. Now, this is positive, but there's a concern here. According to the Landry Light system, we only tend to trend for so long. And we got just about up to that 40-day mark when we were going down, and then we switched to an uptrend. And then we got above this dashed line in early July. That was the 40-day mark for this uptrend, but we're still going up. We're at day 74 now. Now, in my opinion, this is positive until proven otherwise. So it could go on to 100 or 150, whatever it wants to do, but this is still positive. But typically, we don't see trends lasting for this long without some kind of a pullback or a bit more of a decline. Positive here with the proper order, still setting all these bars. The longer we stay in an uptrend, the more bars there are and the longer they get. And we're still positive here. All the anchored moving averages, we're above all of them and all the lines are going up. If we do start to fall, we'll be watching some of these areas, especially this first one here, to see if it ends up providing support. We'll also be watching the 20-period moving average. And we're finally looking positive again with the TTM squeeze. We were going up with the S&P back in July, and this was going down. That's a negative divergence. Then we started to go up, and this was just kind of flatlining. Well, now recently, we've been going up with the S&P again, and we're also seeing the TTM squeeze start to go up again as well. This is another one of those that lately, it's like, okay, we're seeing a lot of jumbling going on right now. This is a risk on to risk off ratio. When this is going up, that's more positive. Folks are willing to get risk on, meaning jump in the stock market. But we're not really seeing a lot of conviction lately. But in the bigger context, it's still positive. Even though we declined with the advanced decline line based on price and volume, we're still above these advancing moving averages. So they're treated as positive. And even with the down day on Friday, we still saw the advanced decline oscillator continue to go up. Now that's over 10 days, so it may not have as much of Friday's action in this calculation, but it is above zero and going up, so it's treating that as positive. And we're still positive here. Even though we declined with accumulation distribution, we're still above the moving average. Now, in the shorter term, you could make a case that we're turning more negative. This is a modified MACD indicator where we started to roll over and we're crossing a little bit below the moving average. So short term, you could say is more negative. In the bigger picture, even though it's declining, it continues to be positive. And the vortex, not really moving all that much here. We're not seeing a lot of conviction with the green line or the red line right now, but the green line is above the red line, so that's positive. And we look internally, and we're seeing more highs than we are new lows, but we're a bit of a contraction with the new highs. But when we take a 10-day average of the new highs minus the new lows, we're still going up with the 5-day chart and the 10-day chart. And then we look at this across a number of different indexes. Now, we did decline on Friday, but we're still above advancing moving averages across all these indexes. And we're positive in the short term. Now, we crossed above the moving average. The black line here, that's the ADX. That's the main indicator for this chart. I put a moving average on here to give us some context, and we crossed back above the moving average. Now, we're above 20, and we're above the moving average. So that suggests a short-term strengthening trend. And the trend is positive because the green line is above the red line. Seeing a very similar thing here with the intermediate term. Back above the moving average, green line above the red line. We're above 20, and as I said, we're above the moving average there. But we're not trending in the long term. The ADX is continuing to drop, even though it's leveling off. We're below the moving average and we're below 20. So this suggests a weakening trend that is now switching over to not being a trend. But in the other way of looking at this, we're still positive because the green line is above the red line. This is the 20-period simple and exponential moving averages. We're well above them, and the lines are going up, and that's positive. This is another area of support that we'll be watching if we start to decline to see if we get down here. Because ever since we finally broke up in April and got above the 20-period moving average, we really haven't gone below it, and it's been acting as support. Well, we did fall down below it when we had the employment report that came in much weaker than expected, but we quickly got back above it. And so we'll be watching to see if we decline, if something like that happens. In the meantime, as long as we're above both the lines and the lines are going up, that is positive. And we're above all these moving averages. Here's the 20 right here that I just showed, and we see a 50, a 100, and 200s, and all of the lines continue to go up. So that is positive. And we're not really far away from the 20-period moving average. That's the boom indicator. It tries to measure price versus a particular moving average, but we are still far away from the 50-period moving average, which is intermediate term, and we're above zero and going up with the 200. So that's positive. The one we're a little bit concerned about is the intermediate term trend being too far away from its moving average, because price has a tendency to boom back to the moving average. It acts like a rubber band, but we've been seeing this now for quite some time. And we're positive with the parabolic SAR daily chart. The dots are underneath. We're also positive with the weekly chart. That's confirming each other. And we're starting to turn over positive now with our oscillators. In the short term, we have the slope and TSI crossing back above their moving average and going up. The intermediate term indicators here, the MACD, the PMO, and PPO. These are three intermediate term indicators, and they're showing improvement. Now, we're still negative with the long-term tricks in KST, but they are starting to level out and possibly begin to turn up. And we're possibly starting to go positive here with the Copic curve. It's crossing above the red line. And even with the down day on Friday, the bullish percent index, which is different than a moving average, different than an oscillator, different than other indicators, that's why I like it, it actually advanced, and it's above its moving average. So this is still positive. And we're positive here with the NYSE bullish percent index. We're above 50. But when we get over to the negative side, the NASDAQ 100 bullish percent index is negative. And we're still positive in the bigger picture here when we look at small cap growth to value, but we've been just going sideways. Now, when CPI came out, that really helped small caps. It looked like, here we go, off to the moon. And then PPI came out, and it's like, okay, let's float back down to earth again here. So we had a good week for the small caps, but they ended up being down in Thursday and Friday's session. And a similar thing here with the mid caps. The growth to value ratio is okay, even though we're dropping below the 50-day moving average with the ratio, but we shot up and now we're starting to come back down here. Even dropping a little bit below the 50-day moving average with the growth to value ratio for the S&P. But in the bigger picture, this is still positive. It's in an uptrend. So we're looking okay when we look at the Qs to S&P and the moving averages going up. We're showing some improvement with discretionary to the S&P. We're above the moving average, and we're still positive when we compare large cap growth to large cap value. We're positive with the large caps, but we're seeing some weakness starting to come in with the mid caps and the small caps here, even though it bounced up a bit on Friday. And then a growth to value ratio here, just coming off of a recent all-time high. That is positive. Improving and still in an uptrend here with discretionary to the staples ratio. And long-term growth, large cap growth, just coming off of a recent all-time high. That's positive, and all the moving averages are going up. Even though we declined, we're still above 50 with those stocks in the S&P above their 20-period moving average. We declined, but still above 50 with the 50-period moving average steady. 100-period moving average steady was actually flat. And we did decline a little bit, but still above 50 with the 200-period moving average steady. And this is a chart that I actually showed a few times in the daily videos. We're crossing above the red line. We had another signal here back in March when things were starting to fall off a cliff. But before that, we didn't get another signal unless you go back to 2003. That's why I don't show this chart in the daily videos. I just mention it and keep it on a list. But the fact that we're crossing above this is turning positive. And we're positive on the weekly chart, which I don't have here, but they are both positive. And that's longer term, and it's a long-term oscillator called a special K. And we are improving here with the 10-day average of the highs and lows for the S&P. This is longer term, and we were coming down with this, and that was causing some concern. Now we're starting to go back up, which is more positive. This is even longer term. This is a 50-period moving average of the new highs, new lows for the S&P. We are rolling over a little bit, but we're still positive because we're above zero, and we have been going up. Now, if this continues to decline, and we start to see the S&P start to go down, this could easily switch over and look more negative. And here's a long-term trend channel going back to 2009. I tried to connect this high back in 2010 and then another one in 2011 and then just extend it forward, where we got a little bit above it in 2014. And then we got a little bit above it after the COVID crash as things were very exuberant. Well, we're getting right up to the upper end of that trend line now. Is that going to provide some overhead resistance? This is, to me, probably the biggest thing that's happening right now. This is a weekly chart of the S&P, and these are pivot points, and we're not above this R1 pivot point. We went above it a little bit, but we didn't close above it, and we won't know if we're going to close above this until a week from now because it's a weekly chart. We may go all the way up here on Monday, Tuesday, Wednesday, and then Thursday and Friday come back down. That means that we still haven't broke that resistance level, because if you look at other times, it'll hit one of these points, and sometimes that will be very critical, and this is longer term. So we're watching this play out and see how things develop. Dow Jones Semiconductors, excuse me, just coming off of a recent all-time high. An SMH semiconductor ETF, also a recent all-time high. We're above the rainbow, even though we declined over 2% on Friday, but that's still positive overall. We're still going up with the semiconductor to Dow ratio, which is positive. Now, the Dow did send an intraday all-time high, but this isn't a really good-looking bar to close or to open at the high and then close down here at the low. Okay, it was still up a little bit, but it gave back a lot of those gains. In the bigger picture, though, it's still in an uptrend, and we were finally able to get above this pivot point. But that bar for Friday is not a real strong vote of confidence. We're still looking good here and still dealing with this R1 pivot point for the NASDAQ. We're a little bit below that right now, and you can see a convergence of this. We're seeing it on a long-term S&P chart. We're seeing it on the daily chart for the S&P. This is a daily chart of the NASDAQ where we're dealing with this R1 pivot point. We're also dealing with it here with the NASDAQ 100. All these things are kind of coming together. So that's why we're thinking that, okay, are we going to hit resistance now and start to go down a little bit, which would pair up with the typical seasonal pattern that happens in August. But we don't know that. I've been saying that for about a month now. I put different things together and I've been trying to share this, but it just hasn't developed yet. But we want to know about it anyway. All right, and we're finally turning back to positive. Not great positive with the momentum of the NASDAQ 100. Now, even though it's above the moving average, that's positive, but it's not a real strong positive because when we were really coming down and we were getting really low readings with the PPO, and then we finally crossed above the moving average, that was when it was negative and everyone thought the stock market was going to go to zero and everything. It finally started to improve. Now we're above the midpoint and seeing a crossover here. That means that we don't have much room to go here to the upside before this is going to become overbought, if that's in fact what happens. So the upside seems a little bit limited, even though this indicator has now switched to positive. And now I have this on the positive side, not because of this chart, but because of the chart right after this. We have not generated a golden cross with the S&P 600 small caps, but we are above both of the moving averages. Had a good couple of up days there, going to the moon, and then we started giving that back. This one is positive because right at the beginning of August, we generated a golden cross. This is another small cap index, the Russell 2000, and it's also giving back some of the gains after having a couple of good days. But in the bigger picture, the MACD is positive. We're declining, but we're still above 50 with the RSI, and we're above both of the moving averages. But when you compare the small caps to the S&P 500, they are bouncing back up, but then they started to come back down. I wanted to include this with the small cap charts. Really, this should be on the negative side of things. We have a long ways to go for small caps to start outperforming the S&P, and we've been seeing that now going back to 2023. Mid caps also are in an uptrend, had a good couple of days to the upside, and then spent the next 2 days giving a lot of those gains back. And the Wilshire just coming off of a recent all-time high, and that's a broad market measure. Also a recent all-time high with the total U.S. stock ETF. FANG index, recent all-time high, the really big stocks. And then the Qs, the small caps, we are coming down a little bit here, but we're well above this blue line, and this ratio continues to go up. And then we look at a stock to bond series of charts to see how, if we're seeing a lot of confirmation here. Now we have the S&P to 3 to 7 year bonds, and it is a general rule when we're above the rainbow like we are now, this means stocks are outperforming bonds. And when we're above the rainbow, that means the market is not anticipating a recession. That means a soft landing. When we were really crashing down here in March and into April, the market was starting to anticipate a hard landing, but then we worked out of that. So for right now, this is still looking positive. And you're going to see a lot of charts that look the same way here. That's by design. Are we seeing the same thing across different measurements that we use? Now, this is really the same thing, but inverted. This is showing how bonds are underperforming stocks. The S&P 1500 is outperforming short-term bonds. A broad market measure is outperforming 3 to 7 year bonds. The tech sector is outperforming 3 to 7 year bonds. The Qs are also outperforming 3 to 7 year bonds. A long-term chart of the NASDAQ 100 weekly here, we're getting above this trend line going back to 2009. Now, we got above it before, but we kind of stalled out once we got a little bit above this line. But that's nothing drastic about that. We could still continue to go up, or is this going to present some kind of problem? And then we look at a NASDAQ 100 to Dow ratio. This continues to go up, even though it declined a bit on Friday. A broad market measure of a 5-period moving average of the highs minus the lows. We were looking a little more negative here. We were declining almost all the way back down to zero. Now it's starting to go back up. And so that's looking more positive there. This is positive. I actually did a video on this a few months ago because as we were really coming down here, we were starting to look like it looked at the end of 2021. This is the SPY to Staples ratio. Staples are more defensive. And we saw this really start to fall. And then the S&P set its all-time high right after that. And then we went into a bear market. Well, the concern was, is something like that starting to develop here? For right now, no. It looked like it for a while, but then we were able to come back up and get above the rainbow. And this ratio is really doing quite well. Now, if this really starts to go down again, yeah, we'll be concerned. But for right now, we're not concerned about that. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Now the negative side here. Now, we did decline on the intraday chart of growth and value. The reason why this is negative is we're seeing the blue line slightly below the red line. When the market's more positive, we want the blue line above the red line. And they're both kind of chopping sideways here, but they did decline near the end of the day. But since the blue line is below, that's why I decided to make it negative. And this, I put some moving averages on here. If you go back to the beginning of July, we had a big move down. Value really outperformed growth. That was the first day of the month in the quarter. It was July 1st. And then we bounced up out of that, and the moving averages were going up. Then we had another down day here with value, and then we started to go back up. And then we had a downward move when the employment report came out, but that was pretty short-lived. And most of the moving averages here are going up. Now we're seeing them start to roll over now. Is this a problem? Now, we could come back up and break above this and turn this back positive, but we don't know that's going to happen. We can only go with what we see right now. And now we're starting to see some weakness coming into the growth to value ratio for the S&P on the 10-minute intraday chart. And we're below zero. We never did get above zero with the balance of power. And we were seeing a longer-term negative divergence. As the S&P was going up, the balance of power was going down and actually turned negative. And then as the S&P was going up after the big down day, July or August 1st, we've been improving here, but we have yet to cross back above the midpoint. And so that's still negative. And we're back below zero with the S&P McClellan oscillator. It was looking better, but then we dropped down below zero. When that's below zero, we're declining based on price. Now, this could also be taken as positive. We are declining based on price, but we're still going up based on volume. Is volume going to overcome price and we're going to be able to go back up? Or is price going to continue to go down and then take volume with it? That's what we're waiting to see play out. We're also back below zero here with the NYSE McClellan oscillator. And it's really hard to see, but we're ticking down a little bit with the summation index based on price and volume for the NYSE. And we had been positive with the Swindlen Trading Oscillator. Now we're starting to turn over and go negative, both based on price and volume. This is the bullish percent index for the NASDAQ 100. It bounced up a little bit on Friday, but it's still below 50. And that's what I use as the line between positive and negative. If we go above 50, it's positive. Below 50, that's negative. And here we are going up with the S&P, and this is going down. Not really a vote of confidence there. And one of our smart money indicators, now the first one was accumulation distribution, where in the short term it's negative. Longer term, you could still treat it as positive. This one is negative. We're declining with the histogram, and the red line's going down. So that's negative. Now, we haven't quite crossed below the moving average here with smart money indicator number 3, but we did decline on Friday. If we see any more of a drop, that's going to turn this to full-blown negative. And we're improving with the Zohorchak method. We were at a -10, now we're at a -6, but we're still below zero. So that's being treated as negative, but improving. And the mass index, this signal was triggered quite a while ago now. It's becoming less and less relevant the more time goes by. But this tries to pick out a reversal in the market, and this is a weekly chart. The daily chart's not telling us anything. But we were going up, which triggered this signal, and we have yet to really start coming down with any conviction. And the financial sector, when you look at it all by itself, it's positive. We're above the 50-day moving average. We're in an uptrend. What's a concern is that we continue to underperform the S&P, and we just generated a recent death cross with this ratio. It's like, is this warning us of something? Is there something wrong in the financial sector? Why is it underperforming the S&P? And why is it lasting for as long as it has? It started about the beginning of May, and we've been seeing a continuation here. Is that going to develop into something that's more negative? Hasn't yet, but we're just watching that. And then home construction is improving. I still have it on the negative side because it has a long ways to go. Now, some of these shorter term moving averages are starting to turn up. You could have said this was still positive, but it did decline a little bit on Thursday and then was up a little bit on Friday. And this is doing a ratio of home construction to 3 to 7 year bonds. Now, we started to see this fall apart at the end of 2024 before the market really ran into trouble. Well, now this is starting to improve. Is that telling us something? But at the same time, what was causing this ratio to go up was that thought that, ooh, maybe a 50 basis point cut. That was what the market was dreaming of after Tuesday, and it lasted into Wednesday. Then reality hit on Thursday when PPI came out stronger than expected, and that could be putting this ratio in a bit of jeopardy. But for right now, it's improving. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then those areas that we're just watching. We're still tending to go down overall with the weekly jobless claims, but we're still getting a pretty high reading with the continuing claims. So the initial claims, people are not losing their jobs as much, but those people that do lose their jobs, they're staying unemployed longer. And we want to keep an eye on volume. And I didn't see this until after I did the daily video. There's a little green blip here. We were slightly above average with volume. And I just like to keep an eye on the average of volume. And then we're still getting a high reading here with the skew index. This means the market is anticipating some kind of a big move. Now, this is a variation on the VIX, and that's why I'm putting it in the what to watch area. Other times we spiked and started coming down. Sometimes that was a top, sometimes that was a bottom, sometimes it was just a continuation. But the market, since this is calculated using out of the money options, somebody has a big bet to the upside or to the downside, and we're not quite sure what that is, and those people tend to be wrong most of the time anyway. But at least this is telling us that some move is still looming in the future according to some option players. And then this is not negative. It's actually more positive because we're above the 200-day simple moving average. If we continue to go up, we're at 8.79% above the 200-day simple moving average. Now, if we get above 10%, doesn't mean that's magical right there. It's just, if you remember back to 2023, we got above this 10% level in July, and then we started to fall back. And then we were going up in April of 2024, got up more than 10% above it. We had a pullback. Then in July, above it, and we saw a pullback. We did not see that this time. And I did a video in July where I said, look at the S&P to Staples ratio. Is that giving us some kind of a problem? And I also brought out a historical chart saying that, okay, we saw a decline in July of 2023, July of 2024. Are we going to see another one in July of 2025? No, it ended up not happening. But at least we were aware of that. Now, where this is going to become a concern is if we go above this dashed line and we get greater than 10% above the S&P. Now, there's no magical level here. We could get up to 12, 13, 14, maybe even 15% above this, but this would just mean the market is getting way, way far away from its 200-day moving average. We're just going to watch this for now. Okay, and then we're keeping an eye on the weighted versus equal weighted version of the S&P. When the CPI came out, we saw the equal weight really doing quite well, but then when PPI came out, the S&P has been holding up a little bit better, but the equal weight version actually declined. And then this is, instead of using traditional Dow theory, we swap out the S&P for the Dow, which is just coming off of an all-time high. And instead of using the transports, we use the NASDAQ, just coming off of a recent all-time high. That's good, and that's confirming each other. But then when you break it down a little bit more, we use the equal weight version of the S&P. We have yet to make an all-time high. Now, we got close, but not quite there. And then we're lagging here when we look at an equal weight version of the QQQs, which is the NASDAQ 100. You could say, now this is positive. I mean, the chart's looking okay here, but you could also pick out a negative divergence between this upper chart and lower chart. And we want to keep an eye on the Staples to Tech ratio. And sometimes this is positive and negative, but it's just been gyrating around a little bit lately. I'm just putting it on the watch list now. And we want to keep an eye on the 10-year yield. We're below that 4.5% level, which is the red line here. If we do start to go back up because the bond market starts freaking out that the inflation is going to come back, if we get up to that 4.5% level, that could also start to pressure stocks. And what's been helping stocks go up is the dollar going down. And we are still in a downtrend, not only here on the daily chart, but also on the weekly chart. And we're dropping back below the 50-day moving average. And then we look at the relationship between different maturities of bonds to see what's the bond market saying about inflation fears. And when this is going down, that means there's not a lot of fear. We're looking at cash to 3 to 7 year bonds. That's still holding up okay. Okay, and then this is in the wrong spot. And we look at the S&P to utilities ratio here. And then, okay, what's going on here? Did I hit the wrong button? Okay, I just have these in the wrong order. We also want to keep an eye on the staples to S&P ratio. When this is going down, that tends to be more positive. I'm just watching this for right now because it's been gyrating around, even though it's been falling more than it's been rising. So that would be positive. Then we look at this other bond study here. TIPS to 3 to 7 year bonds. When TIPS outperform, that's when the market's worried about inflation and interest rates. When this is going down, they're not worried about inflation or interest rates. And we've been just chopping around sideways here and also going sideways when we look at TIPS to the 7 to 10 year study here and look at this on a ratio basis. Now, the reason I usually don't show this, but we just want to keep an eye on this. This is the 3 month yield, which has been just kind of leveling off. Well, you see how it's dropping down now? And if you go back to 2007, we were doing pretty good here, going up, going down. And then it just fell off a cliff. And then we went into 2008 and into the financial crisis, and we didn't bottom here until late 2008, at least with the 3 month yield. And then we finally started to come up out of that. Now, this is just a blip down, nothing to freak out about. But if this really continues to drop, then yeah, we're going to be more concerned about things. And when you couple that with the underperformance of the financial sector, that's why we want to keep this on our radar. Another thing we're watching, which is not inverted right now, is the 10 year to 3 month. Now, the 10 to 2 year yield curve, that's fine. That's normal. This one's been bouncing above and below the zero level, going from inverted to uninverted back and forth. We're not inverted right now, but you can see we're not seeing really any conviction here right now either. All right, then we have what are called bellwether industries, or the semiconductors. They were improving and then pulled back. Home builders were improving, now pulling back a little bit here. Transport showing some improvement, then going sideways. Retail improving, now going sideways. We did get retail sales on Friday. Didn't seem to really help the retail sector all that much. And then regional banks, they were improving and now going sideways. And then we look at some different ratios. This is a weighted version of discretionary to staples. For the most part, it's been going up lately, and that's what we want in a positive environment. The equal weight ratio is also continuing to go up. We're also still going up when we compare tech to utilities. And we're going up, but we came down when we look at biotech, which is growth, to healthcare, which is value. And healthcare is starting to see a little bit of interest. And could it be that there's going to be some buying into healthcare because that's a defensive area, and we're going to see that part of the market do better if we start to decline and growth starts to underperform value? Not saying that's what's going to happen. We're just watching the charts to see if that's what's unfolding. And then we look at hotels, which are discretionary, to utilities, which are considered defensive, pulling back a little bit here, but we were seeing hotels improving. And then here's retail. Now in the middle area, this is the retail chart. Going up here in an uptrend, even though it was down a little bit in Friday's session. But if you go back further, when you compare it to the S&P, retail's been underperforming. We are starting to level out here. And so that's showing somewhat of an improvement there. And then here's the semi to tech ratio. It was looking a lot better earlier in the week. Go growth. And then PPI came out and this ratio started to come back down. And we're just keeping an eye on this. The spread between risky and not as risky bonds. If this continues to go up, that means there's lower fear, and that's more positive for the market. Oil, we're watching that mainly for geopolitical reasons. We're getting down into the 63 range now. We want to keep an eye on the gold to S&P ratio. This continues to decline, and it's because the S&P has been going up as gold has been going sideways. And then the German DAX, the biggest stock market in the EU, still above its 50-day moving average. And we were improving here, pulling back right now when we compare U.S. stocks to German stocks. If the U.S. is going to go back into a leadership role, we would see this ratio continue to go up. And then we look at U.S. versus international stocks. U.S. stocks have been grudgingly improving here, but they've been going down a little bit lately as we got into August, after seeing a big decline earlier in 2025. And then momentum stocks, which sometimes they don't do so well when the market's going up. We're seeing a little bit of weakness here and a little bit of trailing off right at the beginning of June as the momentum stocks were being replaced by the growth stocks. So a little bit of a decline here. And then we look at emerging markets and compare it with developed markets like the US and European markets, going sideways right now. We were trying to show some improvement, and now we've kind of leveled off after we saw emerging markets underperforming developed markets. And that means European markets were stronger because US markets have been underperforming European markets. Then there is the daily, the pivot points for Monday session. I don't know what happened to the volume here. It just went poof. It's not there for right now, but these are already posted on the YouTube community tab and on the website. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.